the risk involved in different projects. Okay? And here, what we're doing is if we can eliminate the risk from a future cash flow, okay, then how much will I pay? That's the question I'm asking, right? You know, we have future cash flow expected from a project, right? But as we all know, the future involves risk. Again, what is risk? What is risk? Uncertainty, yes. Okay? So because future is uncertain, there is risk in the future cash flow. We expect, say, $5 million revenue next year, right? But we are not 100% confident. We are not 100% sure that we will actually receive $5 million. It could be less. It could be more, right? Or it could be negative at all, right? And so on, right? So, think about if we can somehow eliminate the risk or uncertainty from that future cash flow, right? How much will I, or how much am I willing to pay for that, right? All right, so that's the idea. So here, let's look at the example first. Okay? So in this example, we have a project with the initial investment of $10,000. Okay? And next year, $5,000 is expected. Second year, $6,000. 3 years later, $7,000, and so on. Okay? Look at the first column, expected net cash flow. Right? But, well, since we are not certain, right, we are trying to come up with that question. How much will I pay? Am I willing to pay, right? If we can get this cash flow at a certain certainty, with a certainty, right? Well, so there's what we call certainty equivalent factor. Okay? So here, the first one is 1.0 because we're talking about right now. Net investment is right now, today. You have to spend that much to start the project. There is no uncertainty, right? So that's 100% sure, right? Next year, it says 0.9. So what we're in effect saying, what this is saying is, well, if I can eliminate the risk or uncertainty from this cash flow, then I am willing to sacrifice 10% of that cash flow, right? So I'll be satisfied with only 90% of that expected cash flow if I can get it with 100% certainty, right? That's the meaning of this certainty equivalent factor, right? And as you see here, as the years go by, second year, third year, up to 5 years, right? That certainty equivalent factor declines, right? In other words, for the fifth year, 5 years from now, right? We expect $3,000 expect net cash flow, right? But it is so uncertain, anything can happen during the next 5 years, right? So the risk is great. So what this table is showing us is this person or this company is willing to accept only 40% of the $3,000 expected net cash flow if you can eliminate the risk, eliminate uncertainty. Okay? That's the idea, right? Okay, so going back to, previous slide. Okay? So first step in this approach is we have to convert the expected cash flow to certainty equivalent amounts by considering the certainty equivalent factor, right? And then we are going to compute the net present value of the certainty equivalent cash flows. Okay? And while we do the net present value, well, we calculate the net present value, we're going to use risk-free rate as our discount rate, right? Calculating net present value requires a discount rate, right? Which interest rate are we going to use for discount rate? We're going to use risk-free rate. What is a risk-free rate? Yeah.
It's systematic risk that comes from the market.
Okay. Yeah, risk-free rate.
That can't be diversified away.
You're talking about the systematic risk, which cannot be diversified. Okay. Well, that's, I would say, market risk. You can say that's maybe that has to do with the market risk, right? Because when we say systematic risk, another word is market risk, right? So in that case, because of the change in the overall market, every investment is impacted or affected the same way, right? Then the diversification doesn't matter, right? Doesn't matter whether you put entire money in one stock or 100 stock, right? Risk-free rate is, well, literally, we're talking about the risk-free rate. I mean, interest rate without the risk, right? In other words, you know, when you invest your money, right, you have to accept some risk, right? But if you can eliminate the risk from your investment, what interest rate are you willing to accept? Obviously, it's going to be pretty low, right? Because right now, let's say, overall market return, let's say stock market return is 10% annual rate, right? But, you know, stock market is quite risky, right? It's, you know, right now the stock markets are going through a turbulence, right? It's crazy. Yeah. Apparently, China is a big factor, right? In every way, right? Just because China's economic growth has slowed down so much, is slowing down, right? Right now, the entire world is, seems that the stock markets are going down, right? So if you can eliminate this risk from your investment, right? You know, what rate are you willing to accept, right? That's the concept of risk-free rate, right? In practice, in reality, can you find a risk-free interest rate? Is there such thing? Is there such thing as an investment without any risk? Yeah?
The nearest thing would be a
Government bond, yes. U.S. government bond, right? Well, even the U.S. government bond, if you're talking about 20-year bond, right? You know, anything can happen during the next 20 years, right? So, yes, in reality, we use a U.S. government bond rate as a risk-free rate, but only the short-term, very short-term rate, like 3 months, right? 3 months U.S. Treasury bill. It's called the Treasury bill, right? If it's shorter than 1 year, it's called the bill, right? Yeah, so that's the concept of risk-free rate, right? So somehow we find the risk-free rate and we're going to use that as the discount rate. Well, because the idea is we have eliminated the risk from this cash flow, right? So here they call it alpha T, okay? Is called the certainty equivalent factor, right? And the idea is this is the ratio between certain return divided by risky return, right? So it's a little bit confusing because when you look at this table, it gives a notion, it gives an impression that someone came up with this certainty equivalent factor, right? So you multiply this certainty equivalent factor to the net cash flow with the risk, right? And that's how you got 4,500, which is certainty equivalent cash flow. That's what, in fact, this table does, right? You come up with the certainty equivalent factor and multiply it to this, and you got this, right? And then you discount these future certainty equivalent cash flows using the risk-free rate, right? And come up with this net present value, right? But, well, actually, how do you get this certainty equivalent factor, right? Where do you get the certainty equivalent factor? Well, that is how I asked you, I told you, right? Ask yourself or ask any investor, right? If we can eliminate the risk from this investment, how much are you willing to pay, right? So that is more, I guess, realistic approach, right? So apparently, this investor, right, this company said, well, if talking about this $5,000 expected cash flow 1 year later, if we can eliminate the risk from that amount, I'm willing to sacrifice, say, 10% of that, right? So 4,500, I'm willing to accept the 4,500 if we can get it with certainty, right? So the ratio, 0.9, is calculated by dividing 4,500 by 5,000, right? That's what this formula is about, right? So certainty equivalent factor is the certain return you're willing to accept divided by risky return, right? Another way to ask this, or another way to understand this, is indifference. In microeconomics, you learn the indifference curve, right? Indifference curve, right? 무차별곡선. Word is a little funny, right? So this investor obviously is indifferent between $4,500 without the risk and $5,000 with the risk, right? So those two amounts give equal satisfaction to this investor, right? That's the way to understand, right? All right, so once you convert the net cash flows into certainty equivalent cash flows using this concept, using this certainty equivalent factor, right? You can use this, typical formula to calculate the net present value, right? The only thing is the discount rate here, discount rate you use should be risk-free rate, okay? Because we're talking about all the net cash flows are without the risk now. No risk at all. Okay? Any question? Okay. The last thing we're going to talk about in this chapter is risk-adjusted discount approach. Okay? So this is contrasted to the certainty equivalent approach that we just talked about, right? In the certainty equivalent approach, what we did was we adjusted this net cash flow, right? Instead of using actual net cash flow that you expect, we have converted the net cash flow into the certainty equivalent rate, right? And then calculated the present value, right, of all the future cash flows. Okay? In the RADR, risk-adjusted discount rate approach, okay, instead of adjusting the numerator like that, we're going to adjust denominator, or actually the discount rate, right? So we are asking the question, considering the risk, right? What is the appropriate interest rate we have to use to discount the future cash flow, right? So even though we expect all these cash flows in the future, right? Can we really use current interest rate to discount to come up with the net present value, right? Well, the idea is, if we are talking about that, depends on the level of risk of the project, right? if you are investing your money in a little more risky project, right, then maybe we should use a little bit higher interest rate to discount the future cash flow, right? So that's the idea of risk-adjusted discount rate, right? Risk-adjusted discount approach. Okay? So here we come up with this equation, KA star. KA star is the risk-adjusted discount rate, okay? And that's the risk-free interest rate plus risk premium. Okay? And this is just the typical interest rate. Last semester, right, when you learned about this interest rate or risk analysis, right, you probably saw RJ is RF plus theta, okay? RF plus theta, right? RF is, of course, risk-free interest rate, okay? Theta is risk premium, right? And, of course, theta can be okay? Theta can be decomposed into a few different components, right? It could be business risk, market risk, all kinds of risk premium, right? But this is overall risk premium. Okay? So considering the risk, we just adjust. We talked about, if you remember, seniority risk, time horizon, right? Maturity risk, right? So if you compare 1-year bill, T-bill, to 5-year bond, right? Because of that maturity difference, right? You probably demand higher return on the 5-year bond compared to the 1-year bill or bond, right? And so on, right? And depending on whether the bond is considered less risky compared to the stocks, right? And even among the bonds, there are what's called secured bonds, right? Secured bond means these bonds are secured with collateral, right? Like real estate, right? So those things are considered less risky, so you will require less interest rate and so on, right? All right? So that's the idea. The size of the risk premium is subjective. Well, you have to consider all kinds of factors, of course, again. What kind of project are we talking about, right? As we mentioned before, if you're thinking about simple asset replacement, you've been running this business for a long time, right? And now you want to replace your equipment, okay, with a new one, right? Then, there's a little risk there because you don't know about this new equipment, right? Well, usually you're not going to replace with exactly the same one. You probably want to invest in a little more advanced or high-tech equipment, newly developed, right? Then, well, there is a risk that there may be some problem with the new equipment, right? But it is much safer than starting completely new business, right? If you are thinking about another project where you expand your business into a completely new type of business, right? Then obviously the risk is higher in that business, in that project, right? So considering that kind of thing, you have to adjust risk premium, okay? So obviously it can be quite subjective, right? It depends on how many different factors are involved, okay? Are we talking about the new location or new type of products and so on, right? All right. Here, they specifically mention beta risk, adjusting for beta risk, Okay? So we're still talking about this theta, risk premium, right? And overall, we're saying coming up with risk premium is quite subjective. You have to consider many different factors. Okay? One of those factors is beta risk. Okay? What is beta risk? What are we talking about? What is beta in finance? What does it measure? Beta? Systematic risk or market risk. Okay? The way you calculate beta for any investment is you put the market return. Okay. Market return on the horizontal axis, okay? And specific usually company, let's say, firm return, okay, over many years. Okay? So you collect the information, market. For market return, what do we use to calculate beta? Hyunho, what did you use in the project last semester to calculate beta? Oh, you didn't take it from me? Sorry. I guess you were in the other class. Yeah. What do we use for market return? Some index which represent the market. Yeah. You can use any index, but typically we use S&P 500. If you like, you can use Dow Jones, whatever, right? Or any specific market, DAX return or whatever, depending on which country you're talking about, right? So over many years, let's say 20 years ago, there was a 5% annual return in overall market. Say S&P 500 index, right, went up by 5% during the entire year, right? 7%, 15%, minus 2%, whatever, right? And then you're talking about the return on specific company stock, right? So for the same year when the market went up by 5%, this company's stock went up by 8%, right? And when the market went up by 7%, this company's stock went up by 9%, something like that, right? 12 minus 5, right? So you basically run a regression analysis, okay? And fit the best fitting line through the data, right? And that slope, that's beta. Okay, beta. Okay? In statistics, beta is a population parameter, and we usually use beta hat or B1, right? For the estimated slope, right? But in finance, we just call it beta, right? So, if beta happens to be 1.2, what does that mean? What's the story? You found a beta for your company, and it came out to be 1.2. Yeah?
If the specific return is 20% more volatile than the return of the market.
Right. So beta or the slope is change in y over change in x, right? So what that means is every time the return, market return increases by 1%, right? Your specific company return goes up by 1.2%, right? Okay? That's what this means, right? When the market return increases by 1%, your company return, stock return goes up by 1.2%, right? What kind of stock can you say it is, right? If beta is 1.2. Is it relatively risky or safe? Risky, right? Because again, when we say risk in finance, we're talking about uncertainty or volatility, right? And apparently, excuse me, apparently this stock has a lot of volatility. When the market goes up by 1%, it goes up by 1.2%, which means if the market goes down by 1%, right, then the return on this stock will go down by 1.2%, right? Because that's the slope. Okay? So we call this kind of stock very volatile or risky, right? We're talking about market return, market risk here. So adjusting for market risk, right? So here again, risk-adjusted discount rate is risk-free rate plus risk premium, and more specifically, risk premium can be called the beta J. J is for individual stock, right? Specific stock or specific investment, right? So beta for that investment times RM minus RF. Sounds familiar? Okay. So don't confuse with this, right? We're talking about RJ, okay? And here's RM, right? And, okay, so we're talking about here. Well, if you have a certain, beta, beta, right? So for certain level of risk, right? For your investment, right? Let's say, using the typical notation, right? Let's say KJ, right? Required rate of return, right? How do you calculate the required rate of return? Okay? So that can be calculated by RF plus beta J times RM minus, RM minus RF. Okay. What do we call this equation? We call it certain model. I'm sorry, what? CAP-M, right? CAP-M, right? Capital asset pricing model, right? According to the capital asset pricing model, required rate uncertain investment is a risk-free rate plus risk premium, market risk premium, right? And that is beta j times, yeah. So here, this is x value, and this is the slope, right? Because if you think about beta 1, let's say here's the beta of 1, right? And if any investment has beta value of 1, what does that mean? You have an investment with a beta value of exactly 1. What's the story? I mean, I'm just saying, according to the typical, last time we tried 1.2, right? So we found out that investment is riskier than average market investment, right? If beta was exactly 1, what's the story?
Follow the market.
Right. What that means is that investment is exactly as risky as average market return, average market investment, right? Average investment in the market, right? If that's true, then what kind of interest rate or what kind of return would you expect or would you require on that investment? Considering the risk level, and risk level is exactly as the market risk or market average risk, right? Well, I guess you would expect exactly market return, right? Does it make sense? If any investment is just exactly as risky as average market investment, investment in the market, right? So, this is 1, right? Because beta is 1. And this is Rm minus Rf, right? So the slope of this line, this is what we call security market line, right? Security market line, okay, is exactly this. This one divided by 1. Okay? So this is the slope, and this is the whatever the value you have, beta j, right? So you can calculate required, if you have any investment with the beta value of that much, right? You can calculate the required return using this formula. All right? Make sure you understand that concept, right? And that idea is called the CAPM, right? Capital Asset Pricing Model. Have you heard of CAPM? Capital Asset Pricing Model, right? All right, so that's what we're talking about here, right? So considering that, we have to adjust the discount rate, right, when you evaluate any investment, right? So risk premium or market risk premium is beta j times Rm minus Rf, okay? Okay. So finally, once you calculate this required rate, right, how do we actually adjust the company's discount rate, right? Well, there are two separate cases, right? One is the company has all equity, well, which is not really realistic, right? In most cases, companies have equity and debt in their capital structure, right? In other words, when they raise the fund, raise the capital, there are two major primary ways to raise capital: debt financing, equity financing, right? Debt financing means issuing bonds, right, to raise the capital. Equity financing means selling stocks, right? So most companies have debt and equity, right? Well, but let's think about the first all equity case. If there is no debt, right? Then the projects that are highly correlated with firm's return on its existing assets will have a beta similar to firm's beta, right? What that means is if you're thinking about new project, right? And this project is similar to what the company has been doing so far, right? Then you can simply use the company's beta for the new project, okay? But if you're thinking about some new project, which is either more riskier or less risky than the existing product, existing business, right? Then you obviously have to adjust, okay? Any project with higher risk you should use a higher interest rate, higher discount rate, right? Less risky project should go get less risky, lower interest rate, right? So here's the relationship, the beta and the required rate of return. In other words, what's that green line? SML, security market line, right? Because it has a beta on the horizontal axis and the return on the vertical axis, right? So I guess the story is, if the company's beta was 1.2, right? Then according to this security market line, the risk-free rate happens to be 5%. How do you know whether it's risk-free rate? How do you know the intercept is the risk-free rate?
Because beta is shared.
Right, because beta is 0, right? So what that means is if there is any investment without any market risk, that's, the interest rate you should use, right? And so according to this formula, you come up with 13.4%, right? 13.4%. So you will use, if you're dealing with any project which is similar to company's current project or past project, right? Then you will use that. But in case you're dealing with a little bit riskier project, right? Like here, right? Somehow this project involves a beta of 1.7, right? Then according to this calculation, you come up with 16.9%, right? So you should apply that to when you calculate net present value, right? How do you know? This is a new project to you, right? How do you find out the beta for the new project that you have never done? Any idea? You've never been into this business, I guess, right? You're a food manufacturing company, but you're trying to get into shoe manufacturing business, right? So how do you know whether the beta for the shoe manufacturing business is? Okay, right. It's called surrogate company. I'm not sure whether the word is really good. It's like substitute company, right? So you will find a company which is solely in that shoe manufacturing business, right? And find out the beta for that company. Okay? Then you will use that beta for this new project. Okay? That's probably the most reasonable way to come up with the beta for your new project. Okay? Yeah. So that's the case, the all equity case. If you are dealing with all equity case, no debt, right? If the company's capital structure involves both equity and debt, right, then it's a little bit more complicated. Okay? So, well, first of all, you have to obtain a beta for the firm in the same investment class as their proposed investment. Well, investment class means business, I would say, right? Yeah. So we're talking about surrogate firm. Well, I guess here investment class, what they're trying to, I guess my impression is not only in the same business, but ideally you should come up with a company with a similar size, perhaps, right? And similar capital structure, right? Because you're trying to use that company as a model, right? To come up with the beta. Okay? So not only in the same business, ideally you should find a company with similar size and capital structure, right? Anyway, so just find some company which is comparable to your company, right? In the line of business where your new project is going to be in, right? And then it involves 3 steps. Okay? First is leverage the beta of the other firm. What is leverage? What do you mean by leverage in finance?
Using debt to maximize.
Right, exactly. Debt, simply debt, right? Leverage means debt, right? So highly levered firm or highly leveraged firm means the company has a lot of debt, right? That's what that means, right? All right. So first of all, you unleverage the beta of the other firm. Why do we do this? Because the other company that you found, the surrogate firm, may have different capital structure as from your company, right? What is the capital structure? I'm using a lot of new phrase today. I don't think we talked about it. Actually, that's the topic of chapter 12. Starting from chapter 12, we're going to talk about capital structure and cost of debt, right? Well, capital structure is very simple. B/E. B, I guess B stands for bond. E stands for equity, right? So debt-equity ratio. Debt-equity ratio. So out of the total capital of the company, what's the proportion of the debt divided by what's the proportion of debt to equity? Debt to equity, right? So market value of the company's debt divided by market value of the company's equity, right? That's the capital structure, or B/E, or debt-equity ratio. Okay? So probably this new company, this another company, has different debt-equity structure, debt-equity ratio, right? So you have to remove the effect of this debt from the company's beta. Because beta, remember, we're talking about beta for XYZ company, right? And the company is obviously, has this kind of relationship. The company's return has some relationship with market return, right? And we found out it's 1.2, and we say, the company's return is rather volatile, right? So the company's stock is relatively riskier compared to the average market investment, right? The question is, what makes the company riskier, right? What makes the company riskier? What's the reason why the company business is riskier, or the company's return is so volatile? Well, there may be many reasons. Type of business the company is involved, right? But one of the reasons is debt. Debt. How much debt the company has, right? I'm sure you have learned, right, previously. If the company accumulates more and more debt, what happens? Yeah, the company becomes riskier. I mean, they face higher risk of default, right? Because obviously their debt servicing cost rises. In other words, they have to make a lot of interest payments every month or every year, right? So, if the business goes down, if the economy goes down into a recession, their revenue slows down. They may not have enough money to pay the interest costs, interest payment, right? So, yeah, that's the case. So, the investors, people who buy the bonds and equity, the stock of a company, right? They look at this capital structure carefully, right? They will look at the balance sheet and examine how much debt the company has, right? And they found out this ratio is pretty high, debt equity ratio is pretty high, right? Then they're going to require a lot of return. They're going to require a lot of interest rate on the bond the company issues, right? And they're not going to buy their stocks, the company's stocks, right? So yeah, one of the reasons why the company becomes risky is their debt. But the thing is, you're thinking about the new project for your own company, right? And your company's debt structure, debt equity structure is different from this company's debt equity structure, right? So you're trying to remove the effect of debt from the company's, your surrogate company's beta. That's why we call unlever or unleverage, right? We're trying to remove the effect of debt, right? So first step is remove the effect of debt by unlevering the company's beta. And then using your own capital structure, your company's own debt equity structure, you have to recalculate or lever the new beta, okay? And then finally you use that beta to calculate the risk-adjusted required return, right? All right, here's exactly how you do it, okay? Unlevering, okay? So beta U is unlevered beta. You divide the levered beta. Levered beta, BL, is simply the beta of the other company, right? You divide it by 1 plus 1 minus T times BE, B slash E. Here, this debt equity structure, debt equity ratio, is the debt equity ratio of which company? Surrogate company, right? Make sure you understand that, right? So using their own, the surrogate company's debt structure, you divide it using this formula, right? Then you can remove the effect of debt. You come up with the unlevered beta, okay? So then the next step is you re-lever the beta using this formula. And here, debt equity ratio here is your own company, yeah? Your company's debt equity structure, right? Okay? And then you have re-levered the beta. Does it make sense? Okay? Yeah. Tax rate. Come on, 1 minus T. Doesn't it? Right? We use it every time, right? 1 minus T. That's the tax rate, right? Tax rate, I guess probably, most likely, the tax rate will be the same for the surrogate company and for your company. But who knows? Maybe there may be some different tax rates. So, yeah, so you have to pay attention, right? I mean, ideally, you should use, again, the goal is a company which is comparable to your company, only in different business, different line of business. But if you are dealing with a very rare project, right? Perhaps the only company you could find was from another country, right? Or another location or state or whatever, right? And so for those reasons, tax rate may be different, right? So if the tax rate is different, then of course here this tax rate should be the surrogate company's tax rate, right? And this tax rate should be your tax rate, right? Okay. Good question. Okay. Okay, so finally, you come up with this beta, which is relevered, right? So you can say this beta reflects the risk, market risk for the business that you are trying to get into, the business for the new project. And it also reflects what? Business risk, and what's the other risk? It's called the financial risk. Financial risk meaning debt, right? The financial risk is involved with the risk coming from debt payments, debt servicing cost, right? So if your company has a lot of debt, then you have a lot of financial risk, right? So this beta reflects the business and your company's capital structure, debt equity ratio, right? So you use that beta to calculate the required return on the new business, new project. Okay? But there's one more thing you have to do. Okay? I guess we didn't talk about WACC yet. That's the topic of chapter 12. WACC stands for weighted average cost of capital, weighted average cost of capital, right? So when we're talking about two different types of capital here, KD and debt and equity, right? So depending on the ratio between debt and equity, right, the company's required rate of return or cost of capital will differ. Okay? So finally, this K star A, risk-adjusted required return, is WD times KD plus WE times KE. Right? What is WD? That's the weight of the debt. Okay? Let's say B of your company's debt equity ratio is let's say 0.25. 0.25. Then what's the weight? 0.2. If that ratio is 0.25, then what's the this ratio? 1:4, right? 1:4. Is that right? 0.25, 1:4. Yeah, okay. Okay? So that means 20% of your capital is in debt. 80% are in equity. Am I right? Okay? So it's a little bit slightly confusing. If you say 20%, that's 1/5. It sounds like 1/5, right? Right? But we're talking about total debt over B plus E, right? So that is 1 to 5. If it's 20%, right? So you have to be careful, right? So here, WD is 0.2, WE, according to this example, if BE ratio is 0.25, right? Then WD is 0.2, WE is 0.8, right? Times KD. KD is the required rate of return on debt. Required rate of return on debt. Or you can say simply cost of debt. In other words, when you borrowed money, how much interest did you pay? Or how much interest payment are you making on your debt? Right? So, suppose you are making, sorry, I'm going over, just give me just 1 minute, maybe 2 minutes. Okay? KD is 10%. So your debt cost is 10%, and we just calculated risk-adjusted equity, right? Risk-adjusted rate on equity, right? Suppose that came out to be 8%. It should be higher, 15%, right? Then your K will be 0.2 times 10 plus 0.8 times 15, whatever, 2 plus what? 12? 2 plus 12 is 14%, right? So your total rate of required rate of return on the new line of business, new project, should be 14%, according to this calculated example. Okay, so we're done with this chapter, I believe. I have 2 more slides. I'll quickly finish it later, on Tuesday. So on Tuesday, we're going to get into chapter 12. Okay? All right, I'll see you on Tuesday.